Massive growth, tightening margins, and a 4,000 crore target. This is DIXON Technologies' FY26 master plan you can't ignore. Our roadmap for this session covers 4 critical pillars. First, we'll analyze the massive top-line growth and dividend milestones. Second, we'll tackle the Q4 margin squeeze caused by chip inflation. Third, we'll examine the cash engine and free cash flow. Finally, we'll look at the IT hardware pivot and backward integration catalysts. FY26 was a landmark year for DIXON. The company reported a staggering revenue of 49,586 crore rupees, representing a 28% year-over-year increase. Profit after tax grew even faster, up 31% to 1,439 crore rupees. To reward shareholders, they've announced a final dividend of 10 rupees per share, which is a 500% payout on a face value of 2 rupees.
Despite the yearly success, Q4 FY26 revealed some pressure points. Adjusted revenue for the quarter hit 10,520 crore rupees, but growth slowed to just 2% year-over-year. The adjusted EBITDA margin slipped to 4.0%, down 40 basis points. The primary culprit was elevated memory chip costs and geopolitical supply constraints, with material costs consuming a massive 92.4% of revenue in the quarter. It is crucial to look at the quality of the profit. The reported 1,439 crore rupee PAT includes a 665 crore rupee fair value gain on their stake in Aditya Infotech. This is why Q4 EPS dropped over 36% compared to last year, as the previous year had an even larger investment gain. The takeaway is clear. While core operations are steady, headline profits are heavily influenced by investment gains. DIXON is generating high-quality earnings. Operating cash flow reached 1,782 crore rupees, which comfortably covers their 1,644 crore rupee PAT. Even after a massive 1,058 crore rupee reinvestment in capacity, the company still generated a positive free cash flow of 724 crore rupees. This proves DIXON is successfully self-funding its expansion without straining its liquidity.
How does DIXON manage such massive scale? The secret is negative working capital. They have stretched creditor days to 93, meaning suppliers are effectively funding the company's daily operations. Their net working capital improved from -5 days in FY25 to -8 days in FY26. This allows them to achieve peak capital efficiency without relying on bank debt. DIXON has built a balance sheet designed for aggressive expansion. They are now net debt-free with a 773 crore rupee surplus. Cash and equivalents have exploded by 4.7 times to reach 1,241 crore rupees. With a flat debt-to-equity ratio of only 0.1x, their long-term borrowings are easily covered by their cash reserves. Let's break down the segments. Mobile and EMS remains the powerhouse, shipping 32 million units with a 3.6% margin. Consumer electronics is transitioning toward higher-margin products like mini LEDs and soundbars. Home appliances saw 9% revenue growth as they launched new washing machines. Meanwhile, the lighting segment is being moved to a joint venture, targeting double the revenue by FY27.
The next big growth driver is IT hardware. DIXON is targeting over 4,000 crore rupees in revenue from this segment in FY27, which would be a 3x growth from current levels. The strategy is to turn IT hardware into a second massive revenue pillar that stands alongside their dominant mobile and EMS business. To protect their thin 4.0% margins from component inflation, DIXON is moving into in-house manufacturing. They are expanding camera module capacity from 70 million to 190 million units and increasing display manufacturing. They are even looking at specialty EMS for aerospace and defense, a potential 3,000 to 4,000 crore rupee opportunity. No investment is without risk. DIXON has 1,110 crore rupees in outstanding PLI incentives pending disbursement. Furthermore, their razor-thin margins of 4.0% leave zero room for operational error. Finally, the exploration of mobile PLI schemes could hit margins by another 50 to 70 basis points, unless offset by their integration efforts.
Let's weigh the factors. The bull case is built on the explosive IT hardware order book, a net debt-free balance sheet, and aggressive backward integration. The bear case focuses on vulnerability to chip inflation, the looming loss of PLI subsidies, and a reliance on exceptional gains for reported profits. DIXON is scaling at hyperspeed and dominates the Indian EMS space, but they operate on a razor-thin 4.0% margin. Does the massive 4,000 crore rupee IT hardware target justify the current valuation premium they command in the market? Let us know your verdict in the comments below. If you found this DIXON Technologies earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.